Investing doesn't have to start with thousands of dollars. In fact, some of the wealthiest investors began with far less than you might think, sometimes as little as a 100. The truth is, starting small is not a limitation, it's a superpower. 100 might not seem like much today, but if you invest it wisely and consistently, it has the potential to grow exponentially over the years. The key is understanding that investing is not a get rich quick scheme. It's a long-term game. When you begin now, no matter the amount, you're giving yourself a head start in the world of compounding, which is one of the most powerful forces in finance. Every dollar you invest today can become several dollars over time. And the earlier you start, the more you benefit from this effect. Now, you might be thinking, 100 isn't enough to buy a share of some big companies. That's where modern investing options come in. Fractional shares allow you to own a piece of companies you could never afford outright. Exchange-traded funds, or ETFs, let you invest in a basket of stocks for just a few dollars, giving you instant diversification and reducing risk. There are also robo-advisors, which are automated platforms that manage your investments intelligently based on your goals and risk tolerance. These tools make investing accessible to anyone, and with just 100, you can start building a portfolio that grows with you. Of course, investing isn't just about where you put your money. It's about mindset. Many beginners make the mistake of chasing hot stocks or timing the market investment, but this is a recipe for stress and losses. The reality is trying to predict short-term swings is nearly impossible. Instead, focus on low-cost, long-term strategies. Keep your emotions in check and don't panic when markets dip. Fees matter too. Even small commissions can eat into your 100 if you're not careful. Choosing low-cost platforms and funds ensures your money works for you, not for the broker. Finally, the most important part of starting with 100 is building the habit. Investing is like going to the gym. You won't see results overnight, but consistency pays off. Make it a routine to invest regularly, even if it's a 50 or 100 at a time. Read, learn, and track your progress. The discipline you develop in these early stages is more valuable than any immediate return on investment. Over time, as your knowledge and confidence grow, so will the size of your investments. That 100 you started with will no longer just be a small beginning. It will be the foundation of a lifetime of financial growth. Starting small doesn't mean thinking small. Every journey begins with a single step, investment. And in the world of investing, that step is simply deciding to start 100 today can be the spark that ignites decades of financial growth, knowledge, and freedom. So take that step, start now, and let time and consistency do the heavy lifting for you. Investing often feels like something reserved for people with large bank accounts, professionals in finance, or those with access to insider knowledge. Investment. Everything beginners think they need thousands of dollars to get started, but that's a misconception that holds countless people back. The truth is, the power of starting small, sometimes as little as 100, can be far more impactful than most realize. This isn't just about putting money away. It's about building habits, understanding markets, and then taking advantage of one of the most potent forces in finance, compounding. The magic of compounding is simple but profound. It means your money earns money, and then that earned money earns more money. Investment, creating a snowball effect over time. When you invest early, even small amounts can grow significantly because compounding has more time to work its magic. Starting with 100 may seem trivial in the short term, investment, but the key is consistency and patience. Every dollar invested today is a seed that can grow exponentially if nurtured over years or decades. It's not just about the number of dollars. It's about the mindset you develop by taking that first step. Starting small allows beginners to overcome the fear of investing. Investment. Many people hesitate because they feel they don't have enough capital to make a difference. They think that if they can't invest thousands, it's not worth doing at all. This is a critical misconception. In reality, starting with a small amount like 100 is invaluable because it lets you learn without risking large sums of money. It allows you to make mistakes, understand how markets move, and develop confidence in your decisions. This initial experience is priceless. The first to 100 is as much about education as it is about money. Another advantage of starting small is the ability to experiment with different investment strategies. For example, investment with 100, you can explore low-cost ETFs, fractional shares, or even micro-investing platforms. You can test how you respond to market volatility, how you feel when your investments rise or fall. Investment, and what types of assets align with your goals. This experimentation is crucial because it builds the knowledge and emotional resilience needed to handle larger investments in the future. Starting small also encourages disciplined saving. Investing 100 often means finding a way to set aside money regularly. This builds a habit of prioritizing your financial future over immediate gratification. When you commit to investing a small amount consistently, you are training yourself to think long term, and this habit can be scaled as your income grows. Moreover, starting small demystifies investing. Many beginners avoid investing because it seems complicated or intimidating. By beginning with 100, you are taking the first step into a world that once felt out of reach. You'll learn how to set up an account, how to buy your first stock or fund, and how to track performance. Each small step builds confidence, reduces fear, and reinforces the idea that investing is accessible to anyone, not just the wealthy. There's also a psychological advantage to starting small. People often think they need a large amount to make investing worthwhile, but beginning with a manageable sum reduces stress and fear. You are less likely to make rash decisions under pressure and more likely to focus on learning and observing market behavior. Over time, this mindset is crucial because investing is as much about emotional discipline as it is about financial knowledge. Finally, starting with 100 provides a foundation for long-term growth. While it won't make you rich overnight, it sets the stage for a lifetime of financial education and wealth building. That first 100 can grow into hundreds or thousands over time, especially when combined with regular contributions. More importantly, the experience you gain, learning how to analyze investments, how to manage risk, and how to stay consistent becomes the real wealth. Every expert investor began somewhere, and most began with far less than they imagined they needed. The act of starting, even with a small amount, sets you apart from the majority who wait for the perfect time or the perfect amount. Time in the market matters more than timing the market, and starting with 100 gives you that precious time. It's not the size of the initial investment that matters. It's the decision to start to learn and to grow. Small beginnings have historically led to massive results, and in investing, the principle is no different. By taking that first step with 100, you are not just investing money, you are investing in yourself, your discipline, and your financial future. This is the first and perhaps the most important investment lesson in building wealth. It's better to start now, even small, than to wait for a perfect moment that may never come. When it comes to investing with just a 100 investment, the most important principle to understand is that you don't need to buy an entire stock or put your money into complicated schemes to get started. In today's financial landscape, there are numerous low-cost investment options that make it possible for anyone to enter the market, regardless of how small their initial capital is. These options are beginner-friendly, accessible, and designed to help you maximize growth without unnecessary risk or fees. One of the easiest ways to begin is by investing in exchange-traded funds, or ETFs. ETFs are collections of stocks, bonds, or other assets bundled together and traded on stock exchanges. They offer instant diversification because with a single purchase, you're buying a slice of many companies rather than putting all your money into one stock. This diversification reduces risk and increases the likelihood of steady returns over time. ETFs come in all shapes and sizes. Some track broad market indices like the S&P 500, while others focus on specific sectors such as technology, healthcare, or renewable energy. With a 100, you can invest in a fractional share of an ETF, meaning you own a portion of a fund rather than a full share that might cost hundreds or even thousands of dollars. This opens the door for small investors to participate in the growth of large, well-established companies and sectors without needing a substantial amount of capital. Fractional shares themselves are another revolutionary tool for beginner investors. Traditional investing often required you to buy whole shares, which could be prohibitively expensive for companies like Amazon, Google, or Tesla. Fractional shares eliminate this barrier, allowing you to purchase a percentage of a single stock according to your available funds. This means you can start building a diversified portfolio with a 100 investment, spreading your investment across multiple high-quality companies and reducing your risk while still capturing the potential upside of the stock market. Good investment. Fractional investing not only makes large companies accessible, but also teaches an important principle. You don't need to wait until you have a fortune to start investing in growth opportunities. Another excellent low-cost option is using robo-advisors. These automated platforms manage your investments for you, making decisions based on your goals, risk tolerance, and time horizon. For a beginner with 100, robo-advisors remove much of the complexity and stress that comes with choosing individual stocks or funds. They automatically diversify your portfolio, rebalance it when needed, and even reinvest dividends, which maximizes the compounding effect over time. All of this happens with minimal fees, often much lower than traditional financial advisors, which is critical for someone starting with a small amount of money. Many of these platforms have no minimum requirement to start, meaning your 100 is enough to get your portfolio set up and actively growing. Low-cost index funds are another avenue worth considering. Similar to ETFs, investment. Index funds track the performance of a market index, providing broad exposure to a variety of assets. These funds are designed to match the market rather than beat it. Investment, which historically has proven to be a highly effective long-term strategy. They come with extremely low expense ratios, ensuring that the fees do not eat into the returns of a small investment. By investing in a low-cost index fund with the 100, you're essentially planting a seed that can grow steadily over years, benefiting from the overall growth of the market rather than relying on the success of any single company. Micro investing apps also deserve a mention. These platforms allow users to invest spare change or small amounts automatically. They often link to your everyday transactions, rounding up purchases and putting the difference into an investment account. Over time, these small contributions add up, and they make investing habitual without requiring a large initial commitment. For someone starting with 100, micro investing provides both a learning experience and an easy way to grow your money without feeling the pressure of managing a large account. Good investment. It's important to emphasize that all these low-cost options are designed to make investing approachable. The barriers that once made investing seem exclusive are gone, and the key is to start rather than wait. With ETFs, fractional shares, robo-advisors, index funds, and micro-investing platforms, a E100 investment becomes more than just money. It becomes a hands-on lesson in finance, risk management, and long-term planning. These tools empower beginners to learn by doing, build confidence, and develop the habits that will support larger investments in the future. The beauty of these low-cost options is not just accessibility. It's the combination of affordability, simplicity, and potential for growth. Each of these investment methods allows you to participate in the market meaningfully without needing specialized knowledge or substantial capital. By choosing wisely and taking advantage of these beginner-friendly tools, your all under 100 can start a journey toward financial growth, teaching you valuable lessons along the way and setting the stage for bigger investments as your confidence and resources grow. Starting with low-cost investments isn't just convenient, it's smart. It reduces risk, investment, builds knowledge, and makes the often daunting world of investing approachable and actionable. With just E100, you can take your first meaningful steps toward building wealth and creating a foundation that can grow steadily over time. The key is to start, stay consistent, and leverage these tools to maximize the potential of even a small investment. Investing is one of the most powerful ways to grow your wealth over time, but it comes with its challenges, especially for beginners. One of the biggest reasons people fail, even with small investments like a 100, is because they fall into common pitfalls that can easily be avoided with the right mindset and strategy. Understanding these pitfalls early can save both money and frustration, and it will allow new investors to develop habits that lead to long-term success. A critical mistake many beginners make is letting emotions drive investment decisions. Markets fluctuate constantly, and it's natural to feel anxious when prices drop or excited when they rise sharply. However, making impulsive decisions based on short-term emotions can be extremely damaging. Selling in a panic during a market dip, investment, or buying impulsively during a hype-driven surge often locks in losses or increases exposure to risk. The key is to focus on long-term goals rather than daily price movements. Remember that investing is a marathon, not a sprint, and patience is one of the most valuable traits an investor can cultivate. Another common pitfall is chasing trends or hot stocks. Social media, financial news, and even friends can influence investors to jump on a stock or sector simply because it is popular at the moment. While some of these investments might perform well temporarily, Chasing trends without understanding the fundamentals often leads to poor results. Instead of following the crowd, it's important to focus on assets that align with your goals, risk tolerance, and long-term strategy. Diversification plays a key role here, spreading your L100 across different investments to reduce the impact of any single loss. Fees and hidden costs are another area where beginners can unknowingly sabotage their returns. Many investment platforms charge commissions, account maintenance fees, or high expense ratios on funds. While these may seem small at first, over time, they can erode your profits significantly. With a modest L100 investment, fees matter even more because every dollar counts. Choosing low-cost platforms, ETFs, or index funds can minimize these expenses and allow your investment to grow more efficiently. Lack of research and understanding is another pitfall that can lead to mistakes. Investing without learning the basics, such as how a stock, ETF, or fund operates, what drives its performance, and what risks are involved, can be equivalent to gambling. Before putting money into any investment, even a small amount, take the time to understand what you are buying and why. Education doesn't have to be complicated. Simple steps like reading articles, watching tutorials, or using demo accounts can build a foundation that prevents costly errors. Overconfidence is also a subtle but dangerous trap. Sometimes beginners assume that a stock tip, a trending company, or a catchy investment strategy will guarantee success. Overestimating one's knowledge or underestimating market complexity can result in risky decisions that jeopardize even small investments like a 100. Maintaining humility, asking questions, and continually learning from mistakes are essential practices for any investor who wants to grow over time. Additionally, failing to plan for the long term is a major obstacle. Many new investors expect immediate results and become frustrated when returns are modest or take time to materialize. Investing is most effective when approached with a clear plan and realistic expectations. Set goals, then determine your risk tolerance and define how long you plan to stay invested. By treating your 100 not as a quick windfall, but as the beginning of a long-term strategy, you're far more likely to avoid impulsive moves that can derail growth. Another common issue is neglecting the importance of regular contributions. Relying solely on a single 100 investment and then stepping away limits the power of compounding and slows growth. Investment. Consistently adding to your investments, even in small increments, magnifies returns over time and helps smooth out the impact of market volatility. Establishing a habit of ongoing contributions is as important as the initial investment itself. Finally, beginners sometimes underestimate the importance of monitoring their investments, everything when taking a hands-off approach. Keeping track of performance, reviewing allocations, and ensuring fees remain low can prevent small problems from becoming larger issues. Investment. Awareness and engagement don't mean making constant trades. It means being informed, staying disciplined, and making thoughtful adjustments when necessary, avoiding these pitfalls, emotional reactions, chasing trends, high fees, lack of research, overconfidence, neglecting long-term planning, inconsistent contributions, and poor monitoring creates a strong foundation for success. For someone starting with just a 100, avoiding mistakes is more important than achieving massive returns immediately. Each dollar saved from unnecessary errors compounds over time, and the lessons learned set the stage for larger investments in the future. By understanding common mistakes and proactively addressing them, beginner investors can transform a small starting sum into a meaningful, long-term financial journey. Success in investing is less about luck and more about preparation, discipline, and the ability to avoid traps that sabotage growth. Starting small provides the perfect environment to learn, make minor mistakes, and develop the habits that will pay off exponentially as investments and knowledge grow. When it comes to investment, one of the most important lessons beginners often overlook is that building wealth isn't just about the money you put in. It's about creating a consistent habit and mindset that will serve you over a lifetime. Many people get caught up in trying to find the perfect stock, fund, or strategy. But the truth is, consistency and discipline far outweigh the impact of a single large investment. Starting with what 100 is not just a financial decision, it's an opportunity to build a long-term habit that will multiply your success over time. Establishing the habit of investing early is powerful because it transforms the act of putting money aside from a one-time event into a routine part of life. When you consistently invest, even in small amounts, you are training yourself to prioritize your financial future over immediate gratification. This mindset shift is crucial because the wealthiest investors didn't become successful overnight. They became disciplined investment. consistent and patient. Regular investing allows you to ride out the ups and downs of the market without panic or impulse. Everything the advantages of building a habit is that it removes the pressure of timing the market perfectly. Many beginners waste time and energy trying to buy at the lowest price and sell at the highest. Investment often missing opportunities because they wait for the perfect moment. By investing consistently, you automatically take advantage of dollar cost averaging. This means you buy more shares when prices are low and fewer shares when prices are high, smoothing out the effects of market volatility and reducing emotional stress. Dollar cost averaging is a strategy that emphasizes consistency over perfection, and it works remarkably well over the long term. Another important aspect of habit-based investing is the compounding effect over time. When you invest regularly, even small contributions like a 50 or a 100, your money grows not only from the returns on your investments, but also from the returns on those returns. This exponential growth is often underestimated by beginners, but it's the cornerstone of long-term wealth creation. Starting a habit early maximizes the power of compounding because time becomes your greatest ally. And building the habit also encourages continuous learning. Each time you invest, you gain insight into how the market works, how different assets perform, and how your own emotions react to gains and losses. Over time, this experience builds confidence and financial literacy, which are invaluable for scaling your investments in the future. Investing a 100 consistently teaches patience, discipline, and how to manage risk, lessons that are far more valuable than any short-term gain. Furthermore, creating a habit turns investing from a chore into a lifestyle. It becomes second nature to review your portfolio and allocate funds and explore new opportunities. This approach ensures that your investment strategy evolves with your financial goals, income, and knowledge. When investing becomes a habit investment, it's no longer a decision made once in a while. It becomes a standard part of how you manage money. Habit-based investing also helps you avoid the common trap of inactivity or procrastination. Many people delay investing because they feel they don't have enough money, knowledge, or time. By starting small and making investing a consistent habit, you overcome these psychological barriers. And each small step reinforces the idea that building wealth is accessible to anyone willing to commit to the process. Another key benefit of building a habit is that it fosters accountability. When you commit to investing regularly, you are more likely to track your progress, set goals, and make adjustments as needed. This structured approach increases the likelihood of success because it replaces guesswork with deliberate action. It also helps in cultivating a mindset focused on long-term growth rather than short-term speculation. Importantly, habit building is scalable. Starting with A100 is just the beginning. Once you have established the routine, you can gradually increase your contributions as your income and confidence grow. Investment. The habits you develop early, consistency, patience, research, and emotional discipline remain applicable regardless of the amount you invest. And they are what ultimately separate successful investors from those who struggle. Finally, now everything investing as a habit shifts your perspective from seeing it as a financial obligation to treating it as an empowering tool for your future. By committing to regular investment, you are investing not just in the market, but in yourself, your knowledge, and your long-term financial freedom. Over time, the money you consistently invest, combined with the lessons learned, creates a compounding effect far greater than what a single large investment could achieve. In short, building a habit around investing transforms the small act of putting a 100 into the market into a lifelong strategy for growth, learning, and financial independence. Consistency, discipline, and patience are far more valuable than timing, luck, or a single perfect investment. By focusing on the habit investment, you create a foundation that allows even modest contributions to grow into significant wealth over the years, proving that the easiest way to succeed in investing isn't by starting big, it's by starting consistently.